Most people think money becomes expensive because someone decides it should. A meeting happens, a button gets pressed, interest rates go up. That's the story we're told. But the uncomfortable truth is this. By the time rates rise, the real decision has already been made somewhere else, and not by who you think. Right now, across the US and Europe, money is more expensive than it's been in years. Mortgages cost more. Business loans shrink. Credit card balances feel heavier every month. We're told this is policy, necessary, controlled. But if that were really true, money would only become expensive when governments wanted it to. History says otherwise. To understand who really decides, we have to zoom out. Imagine a government that needs money, not for something dramatic, just to function. Salaries, healthcare, infrastructure, debt payments from the past. Tax revenue helps, but it's never enough. So governments borrow. They sell promises, IOUs with interest, bonds. At first, it feels harmless. Borrow a little, pay it back later, roll it over, repeat. But here's where the system quietly changes. Every time a government borrows, it enters a relationship, not with voters, not with politicians, with lenders. At the beginning, the government sets the terms. Rates are low, demand is strong, confidence is high. But confidence is not permanent. Lenders don't care about speeches, they care about math. Debt levels, future obligations, growth that may or may not arrive. Eventually, they ask a simple question. How much risk are we actually being paid for? That's when money starts to get expensive. Not because a central bank wants it to, but because markets demand it. Central banks announce rates, but they don't invent them. They react. Bond markets move first. Investors reprice risk. Yields rise quietly. By the time policymakers speak, the pressure is already there. Inflation creeps up. Debt grows heavier. Trust thins out. Raising rates isn't power, it's a response. Here's the uncomfortable math. When debt is large, small rate changes matter. 1% doesn't sound dramatic, but on trillions, it's enormous. That cost doesn't disappear. It competes with schools, healthcare, and public investment. Leaders face a trade-off no one campaigns on. Keep rates low and risk inflation. Raise them and strain the system. Either way, someone pays. Publicly, higher rates are about fighting inflation. Quietly, they're about survival. Keeping lenders calm, signaling discipline, avoiding something worse. Because when confidence breaks, money doesn't just get expensive, it becomes scarce. Scarcity spreads fast. Businesses pull back, hiring slows, growth weakens. Then the irony appears. The tool meant to control the economy starts controlling the people using it. At that point, no one is fully in charge. Not politicians, not central banks. The system is. A system built on expectations, incentives, and fear of losing trust. That's why money becomes expensive at the worst times, during slowdowns, during crises, when help is needed most. Not because someone wants pain, but because confidence has a price, and confidence always charges interest. So who really decides when money becomes expensive? Not a single institution, not a single meeting. It's decided collectively by lenders, markets, debt levels, and time, by promises made years ago colliding with today's reality. The real question isn't who controls interest rates, it's what happens when the cost of money starts deciding everything else, and whether a system built on permanent borrowing can ever stay in control.